Once you've built up a retirement savings account, the tough question is, how do you correctly take that money out of the account? Let's check in now with Craig Bolanos, the CEO and founder of Wealth Management Group. Craig, what's your common sense for people who are turning 72 and now have to deal with required minimum distribution?
Whether you're on the cusp of retirement or already enjoying retirement, you need to make sure you have a command of the basics of required minimum distributions. So what's an RMD in the first place? Well, it's the minimum withdrawal that you as a retirement account holder need to take and hence pay taxes on from your traditional IRA, rollover IRA, SEP IRA, 401k, 403b. And those required minimum distributions begin when the account holder, you, attain the age of 72. And bear in mind that failure to withdraw enough money is going to hit you with a 50% penalty. That's what I call an expensive mistake. So how do we do the calculation? How do we come up with this required minimum distribution? Well, it's a bit complicated, but at a level of 10,000 feet, we take your current age, we apply that age to something we call the IRS Uniform Life Expectancy Table, and we take that factor against your previous December 31st balance, and that's how we arrive at the amount that is your required minimum distribution.
What else do people need to know about taking money out of their retirement account?
Well, one of the most common questions that arises when it comes to the discussion of RMDs, required minimum distributions, is can I take a distribution from one account to cover the totality of all of my accounts? And the answer to that's a little tricky, believe it or not. You know, if you are a IRA owner, aka you have several IRAs, you need to calculate the RMD for each IRA, but yes, you can take a withdrawal from just one of those accounts in an amount sufficient to cover the cumulative RMDs from your various IRAs. However, here's where it gets tricky. If you have a 401k and an IRA, you need to take a separate distribution from each. In this case, you can't take money from an IRA to count towards the RMD of your 401k. Now, another consideration, taxes. It always matters. And when you're adding additional income to your 1040 through RMD withdrawals, you really need to make sure you're withholding at the right federal and, if applicable, state level. What do we recommend? I want to make sure there's enough money being withheld so that you're on a safe harbor. That means you'll never be subject to any underestimated tax penalties or interest. Timing also matters when it comes to required minimum distributions. I think for most investors, a portion of their IRAs, 401ks, can and always should be invested in great companies of America, invested in stock. And I've yet to see an investor get hurt as long as they weren't forced to sell when stock prices are low. And given RMDs require you to sell a part of your retirement account to take the withdrawal, that's one of the reasons once you hit the age of 72, you're going to want to have a small amount of safe capital at a minimum in your retirement accounts so that you can withdraw from that safe capital to satisfy your RMD, even if we're going through a period of suppressed market prices. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you want to learn more, you can. Check out our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.